Welcome to this Premier training video which looks at double entry transactions and the compilation of a trial balance. Throughout this session, we will look at the purpose of the ledgers and the trial balance. We will look at the different ledgers and consider what they represent and how the balances are then translated into a trial balance. We'll have a go at completing some double entry transactions of both the cash and credit nature. And finally, we will conclude the session by preparing a trial balance, which will provide us with a mathematical check that double entry has taken place. The ledger is divided into three areas: the general ledger, the receivables ledger, and the payables ledger. A business will have a huge volume of transactions, and the different ledgers are a way of organising these. In the general ledger, we will have details of expenses, assets, liabilities, purchase transactions, income, and capital balances. And these are all recognised within that general ledger and will ultimately be fed through into the trial balance. The receivables and payables ledger are often referred to as our subsidiary ledgers, and these provide the detail. Within the receivables ledger, we have all our receivable accounts, all our credit customers. Each individual receivable will have their own receivables ledger, which will recognise all the transactions that have taken place with that business. This allows the accounts receivable or credit control team to chase the correct amounts at the correct time from our credit customers. The payables ledger is a breakdown of all our payable accounts, our credit suppliers. And just like the receivables ledger, each individual payable will have their own payables ledger account, showing all the transactions that have taken place. This will ensure that the accounts payable team make the appropriate payments at the correct time. When looking at the ledgers, it's sometimes easy to see it from a visual point of view. The general ledger is that main ledger, and it's sometimes referred to as the main or the nominal ledger. And it homes all the accounts that are relevant to our trial balance. And that's something we'll revisit as this PowerPoint progresses. Sitting directly under that general ledger are our two subsidiary ledgers, our receivables and our payables ledger. The receivables ledger is responsible for detailing all the receivable accounts that we have, all our credit customers. As a business, if we transact with 50 credit customers, then we will have 50 ledger accounts in that ledger. Similarly, from a payables ledger point of view, this details all our payable accounts, all our payable balances, our credit suppliers. And if we transact with 20 credit suppliers, then we will have 20 individual accounts within the payables ledger. The receivables ledger and the payables ledger provide the detail. It provides a breakdown of the individual balances for receivables and payables. And that allows our accounts receivable and our accounts payable teams to ensure that debt is collected in a timely manner from our receivables and that credit terms are not exploited with our payables and appropriate payments are made at the appropriate time. The receivables ledger is ultimately an asset balance, as it shows the amount due to the business from its receivables. And the payables ledger shows the liability the business has, what we owe our suppliers. If I'm the manager of the business, I'm not too concerned with the individual balances on the receivables ledger accounts, or the payables accounts for that matter. What I am concerned with is the total exposure to the business. And therefore, within the general ledger, you will have a receivables ledger control account and a payables ledger control account. And that summarises the details from those subsidiary ledgers. So within the receivables ledger control account, I will have one figure which tells me the total value that the business is due from their receivables. And within the payables ledger control account, I will have one figure which tells me the total exposure, the total liability the business has to their payables. It is only the accounts within the general ledger that feed into the trial balance. So both those receivable and payable control account balances are ultimately recognised in the general ledger, featuring in the trial balance and ultimately featuring in the financial statements of the business. To help embed knowledge and understanding, it's often useful to complete a relevant activity. Let's look at some ledger accounts and let's decipher whether they belong in the receivables, payables or general ledger. By now, we should have a relatively comprehensive understanding of the nature of these ledgers and what they actually represent. We have a whole host of ledger account names here, and all we're going to do is assess where they are recognised. The rent account is an expense account and is recognised in the general ledger. The carriage inwards account recognises the cost of getting goods from your supplier into your business. It's in the general ledger. A credit supplier will have an individual account in the payables ledger, showing the liability the business has to their payable. Receivable accounts sit in the receivables ledger, showing the value that receivables owe the business. The bank account could be an asset account, it could be a liability account, depending upon whether funds are available or the business is overdrawn. But regardless of the balance, it will be recognised in the general ledger. Carriage outwards recognises the cost of getting goods from your business to your customers. It's considered to be an expense of the business and recognised in the general ledger. Electricity is also an expense and recognised in the general ledger. A credit customer is someone we trade with on credit. We make sales to them and allow them a period of time to make payment. Credit customers are receivables and therefore recognised in the receivables ledger. Wages are an expense and in the general ledger. The sales account recognises the revenue that the business has generated from selling its product. Sometimes there's a temptation to group accounts together, and sometimes learners can get confused and believe that the sales account is recognised in the receivables ledger because it's a connected transaction. The sales account is a revenue and income account and is recognised in the general ledger. Purchase returns recognise the value of goods that we've returned to our suppliers because of damaged, inferior quality, incorrect goods. That account is recognised in the general ledger. Any bonuses paid will be recognised in the general ledger. Insurance is an expense and, like all other expenses, will be recognised in the general ledger. Commission received is a form of sundry income and will be recognised in the general ledger. Sales returns recognise the value of goods that the business has had returned to them from their credit customers. This is ultimately an expense to the business because we've done something wrong, we've sent damaged, incorrect, faulty goods, and therefore be recognised in the general ledger. The rates account is an expense account and is recognised in the general ledger. The purchases account records the value of goods we've purchased with the intention of selling on at a profit, again in the general ledger. And finally, any payables accounts will belong within the payables ledger, recognising the liability the business has. At first glance at that table, there's a lot of blue text on there. There's a lot of general ledger accounts, and that really is the story of the ledgers. The receivables ledger records the individual customer accounts. The payables ledger records the individual payable accounts. And when we talk about receivables and payables, we're talking about credit customers and credit suppliers. All other accounts, assets, expense, income, liability accounts will be recognised in that general ledger. The trial balance is a term that you probably are familiar with at this point in your studies. It's an assessment criteria as part of the Level 2 financial accounting units. The trial balance is something we'll continue to look at throughout the remainder of this presentation, but it's proof that the dual entry principle has been applied. It's a mathematical check that debits and credits agree that double entry has taken place, but it does not prove that no errors have been made. It's also the starting point to a completed set of financial statements, and as you will progress with your studies, you will look at a statement of profit or loss and a statement of financial position, and the starting point for those financial statements is indeed the trial balance. At the end of a period, and that could be a monthly or a yearly period, a business will produce a trial balance. You can see this business is called Bradley Enterprises, and the trial balance is given as at the 30th of November 2024. Instantly, our eyes are drawn towards the bottom of this trial balance to make sure our two amounts agree, and they do. And as previously said, this is proof that double entry during the period has taken place. It proves double entry has taken place. What it doesn't prove is that the right double entry has taken place. So whilst we have a trial balance with debit and credit columns that balance, within those numbers there could be errors. And those errors will be spotted as you prepare your financial statements, and that's something you'll look at as your studies progress. For now, we can look at our trial balance and we can make certain assumptions and conclusions. We can see that we have an asset balance at the bank of £1,920. That's money in the bank. We can see that there has been an investment in this business by the owners of £2,000, the capital figure. We can see that sales revenue has generated £515. The VAT balance is a credit balance indicating at this point we owe HMRC. We have a liability. Purchase figures are £285, indicating this is the value that we've purchased goods for that we intend to sell on at a profit. We've incurred an expense during the period. We've paid rates of £160. At the end of the period, our credit customers, our receivables, owe us £360, and we owe our suppliers, our payables, £180. What we will continue to look at over the coming slides is a number of cash and credit transactions, and then we will conclude the session by looking at how those transactions impact these balances. The first transaction we will consider is a capital investment. Andrew invests a further £2,000 into his business, Bradley Enterprises. So we firstly need to consider the two accounts that are involved in this transaction. We will need a bank and a capital account. Within these accounts, you can see there is already a balance brought down, and these balance brought down figures have been drawn from the trial balance on the previous slide. In the bank account, we have a debit balance of £1,920. We have an asset at bank. And in the capital account, we have a credit balance brought down of £2,000, recognising the initial investment made in this business by its owner. When Andrew invests a further £2,000 into the business, we will record this by debiting the bank and crediting the capital account. We will debit the bank because the asset of bank is increasing. We will credit the capital account because it is a further investment in the business by the owner. When we record double entry, we need to ensure an appropriate narrative is recorded. In the bank account, you can see that the narrative against the £2,000 debit is capital, and this recognises the account name where the opposite entry has been recorded, where the credit entry has been recognised. In the capital account, against the £2,000 credit, you can see the narrative is bank, and that recognises that the debit entry, the corresponding entry to this credit, is recognised and recorded in the bank ledger account. The next transaction we look at is a loan transaction. Bradley Enterprises takes out a loan of £5,000. These funds are transferred into the business bank account. So we naturally need a bank account to record this receipt. The other account we need is a new account called loan. Within the bank account, you can see there is the initial balance brought down from the trial balance, and there is that £2,000 capital, which is from the previous slide. Up until now, this business has not undertaken a loan, and therefore in the loan account there is no balance brought down to recognise. A loan has been received of £5,000. This £5,000 will be a debit to the bank to increase the asset of bank, and we will credit the loan account to recognise the liability that the business has. Our next transaction recognises the purchase of a non-current asset. Bradley Enterprises buys a motor vehicle for £2,500. As we're not given any additional information about how this asset has been financed, it's safe to assume it was from the bank balance of the business. And therefore the two accounts that we require is the account of bank and motor vehicles, a non-current asset account. In the bank account, you can see the initial balance brought down and the two additional transactions that we've previously discussed. When we purchase this motor vehicle, we will debit the motor vehicle non-current asset account and we will credit the bank account. This reduces the asset of bank. The narratives that we use recognise the name of the account where the opposite entry is recognised. Bradley Enterprises purchases goods for resale on credit terms for £1,200 plus VAT. With this transaction, there is no immediate exchange of funds, and therefore this is a credit transaction. Unlike previous questions, no bank will be involved in this initially, and therefore we have to consider how we capture the liability this business has. We will need three accounts to record this transaction. We will need a purchase account to recognise the value of goods the business has purchased with the intention of selling on at a profit. We will need a VAT account to recognise the value of the VAT that we can reclaim. And in the general ledger, we will need a Payables ledger control account, and this will record the total liability the business has to their payable. Those three accounts already have balance brought down values in there, and those balance brought down values are taken from the trial balance we've previously seen. When we record a credit purchase, we debit the purchases account to recognise the value of the purchase. We debit the VAT account because this records the amount of VAT that is reclaimable. And we credit the Payables ledger control account with the total amount of the purchase because it's the total value the business owes. This is the liability the business has for the goods plus the VAT. In the Payables ledger, there would be another entry for this transaction, and it would be recorded against the individual supplier. The very nature of this question means we don't have sufficient information to do that. Our transactions are primarily concerned with the general ledger, but for appreciation purposes, it's important to recognise that a further credit entry would be made into the individual supply account for the amount of £1,440. This time we're concerned with the sales of the business, and we can see here that sales have been made on credit for £4,000 plus VAT. There is no immediate exchange of funds with this transaction, and therefore this is a credit transaction. Because of that, no bank account is required. But we still need to capture the asset the business has, the amount that the business is owed by their receivables. And we will do that by looking at the control account. For this transaction, we will need sales, a VAT, and a receivables ledger control account. The sales account captures the revenue that has been generated by the business, and there is a balance brought down in there of £515 taken from the trial balance. In the VAT account, we have the initial balance brought down, but we also have the £240 which was taken as a result of the purchase that we've previously looked at. In the receivables ledger control account, we have a debit balance of £360 taken from the trial balance, demonstrating the fact that we are owed £360 from our credit customers. When we record a credit sale, we debit the receivables ledger control account with the full value, the goods plus the VAT. We credit the VAT account because this is money that is owed to HMRC. It's a liability we have. And we credit the net amount through the sales account to recognise the revenue that has been generated from this sale. The total amount is debited through the receivables ledger control account to show how much this customer owes to the business. With these transactions, we are only recording those items in the general ledger. However, you need to appreciate that there would be a further transaction, a further debit in the individual receivables account in the receivables ledger. The very nature of this question is we don't have sufficient information to make that entry because we're not given the individual name of that receivable. For our purposes, we're simply looking at those accounts in the general ledger. Our final transaction to deal with is the payment of rates of £180. This will involve the bank account, and therefore we will need a bank account and a rates account. The bank account is quite busy with the balance brought down and the other transactions that was previously been discussed. The rates account records the balance brought down taken from that initial trial balance. Rates are an expense of a business, and therefore when we record this transaction, we will debit the rates account and we will credit the bank account. And we will always use the narrative of the name of the opposite account. We started the period with an initial trial balance as at the 30th of November. Since then, we have processed a variety of both cash and credit transactions. Before we can compile a final trial balance for the period, we have to find out what the new balances are on our ledger accounts. And to do that, we must be competent with balancing off a ledger account. To help with this, there are 5 steps to consider. Step 1 is we add up the debit and credit side of the ledger account. And it's advisable to do this away from the ledger account itself, maybe on a scrap piece of paper. Step 2 is we find the difference between the debit and the credit side of the ledger account. This difference is placed on the smallest side of the ledger account with a narrative of balance carried down. Generally, a date will be required, and that will generally be the end of the period unless the question dictates otherwise. Having completed step 3, step 4 is a check that we've done everything correct. Because in step 4 we insert totals into both the debit and credit side of the ledger accounts. And if step 3 has been completed correctly, those totals will agree, will mathematically balance. The final step is to insert the balance brought down on the opposite side of the ledger account to the balance carried down, and the date of that entry will generally be the start of the next accounting period. But please do observe the instructions in the individual questions for that. Let's have a go at balancing some ledger accounts. We have talked about the 5 steps, but let's see them in practice. Step 1, we find the debit and the credit balances. And I've just added up the debit balance to be 8920 and the credit balance to be 2680. Step 2 is to find the difference. That difference between £8,920 and £2,680 is £6,240. As part of step 3, I will place this difference on the smallest side of my account, and I can see from my workings that will be the credit side of the account. Balance carried down, £6,240. If I have completed step 3 correctly, then step 4 is concerned with inserting totals into both the debit and credit sides of the ledger accounts. These should mathematically agree, and they do, and that provides me with confidence that step 3 has been completed appropriately. The final step is to insert the balance brought down on the opposite side of the ledger account to the balance carried down, and this balance brought down will commence the new period, will be my opening balance as at the next period. The balance carried down was on the credit side, which means the balance brought down will be a debit of £6,240. With most things in accounts, practice really does make perfect, and therefore it's important to take time to balance off our ledger accounts to arrive at our new balances, and in doing so we'll become more confident with those 5 steps. Step 1, we'll find the total of the debit and the credit sides. That's relatively straightforward in this example because there's no entry on the debit side of the capital account. Step 2, we will find the difference. Again, mathematically, that's not too challenging. Step 3, we will place this difference on the smallest side of the ledger account, and we can see that will be the debit side. Step 4 is our mathematical check that transactions and balances have been totaled correctly by inserting those 2 balances on the debit and credit side of the account which agree. And the final step is to insert the balance brought down of £4,000 on the opposite side of the account to the balance carried down. Again, for the loan account, we add up the debit and credit balances. We find the difference. That difference is placed on the smallest side of the account. We insert 2 totals and we show the balance brought down at the start of the next period. There's sometimes an argument as to why we need to balance an account if there is just one balance in there. It's good practice to do so. It practices your skill, but it also shows an examiner that you have the ability and the understanding to close one period and open the next. The next account is the motor vehicle account, the non-current asset account. There is no balance brought down in this account because this was a new ledger account that we've dealt with during this period. We've purchased a motor vehicle for $2,500, and therefore to balance off this account, we will add up the debit and credit sides, find the difference, relatively straightforward in this example as there's only one transaction, place that difference on the smallest side of the account with two totals and a balance brought down at the start of the next period, recognising the fact that this business owns a motor vehicle for £2,500. As previously said, there is an argument that for transactions or for accounts with only one entry, is there a need to balance it off? But it certainly is good practice to follow the process. Our next account is the purchases account. This recognises the value of goods we have purchased for the intention of selling on at a profit. The steps that we follow, step 1, is we find the totals of both the debit and the credit side. We find the difference and place that difference on the smallest side of the account. Two totals of £1,485 and a balance brought down at the start of the next period of £1,485. The last account on this slide is our Payables ledger control account, which deals with credit purchases. We can see the two entries that are already existing in those accounts. We will find the difference between the debit and the credit side and place that difference on the smallest side of the account. Two totals and a balance brought down on the credit side of the account for £1,620, recognising the fact that this business has a liability to its payable of £1,620. The sales account recognises the revenue that the business has generated from selling their products. We started the period with a balance brought down of £515, and during the period we made credit sales of £4,000, detailing the net value in the sales account. Like any other account, we will balance this ledger account off by going through those 5 steps, totalling up the debit and credit side, finding that difference and placing that difference on the smallest side of the account. Two totals which should mathematically agree, and then a balance brought down at the start of the next period of £4,515. The next account is the VAT control account, and this has entries on both the debit and credit side. So step 1, we find the totals of the debit and credit sides. We find the difference and we place this difference on the smallest side of the account. That means that on the debit side of the account we have a balance carried down of £590. Two totals which should agree, and then a balance brought down at the start of the next period of £590, remembering the balance brought down is always on the opposite side of the account to the balance carried down. This balance brought down of £590 shows that the business has a liability to HMRC for this amount. The Receivables ledger control account recognises the value that our credit customers, our receivables, owe the business. We had an opening balance of £360 and total gross sales, credit sales of £4,800 during the period. To balance off this account, we will recognise a balance carried down on the credit side of the account of £5,160, two totals, and a balance brought down at the start of the next period, recognising that our credit customers, our receivables, owe us £5,160. The final account we look at is our rates account, the expense account. We can see the balance brought down of £160 and that transaction that we've encountered during the course of this presentation. Therefore, step 1 is to add up the debit and the credit sides. Step 2 is to find the difference, and step 3, placing that difference on the smallest side of the account. We which obviously in this case is the credit side. 2 totals as part of our step 4 process, and a balance brought down of £340 on the debit side of the rates account. We've balanced off all our ledger accounts now. Now we can start to prepare our final trial balance for the period. We have started the period with an initial trial balance. We have completed some double entry transactions, and now it's time to update that trial balance with those transactions. The bank account showed a balance brought down of £6,240. The balance brought down is on the debit side of the bank ledger account, and it will be recorded on the debit side of the trial balance. The capital account has a balance brought down of £4,000 and will be recorded on the credit side of the trial balance, just like the balance brought down is a credit in the capital account. The loan account is a liability account, and it shows what we owe. It has a balance brought down of £5,000, and therefore we will have a credit against the loan account of £5,000 in the trial balance. The motor vehicle account is a non-current asset account of £2,500, and that will be shown as a debit in the trial balance. Our purchases account has an updated balance brought down of £1,485, recognising the value of goods purchased with the intention of resale. The Payables ledger control account shows the liability we have to our payables, our credit suppliers. The balance brought down is a credit, as will the balance in our trial balance. The sales account again has been updated to reflect the credit transactions that have taken place during the period. The balance brought down is £4,515 as a credit in the ledger account, and that will be recognised as a credit in the trial balance. The VAT control account shows a balance brought down on the credit side in this question. It recognises the liability we have towards HMRC, and it will be shown on the credit side of the trial balance. The receivables ledger control account looks at the amount that the business is owed by their receivables, their credit customers. The balance brought down in the ledger account is £5,160, and that will be shown as a debit in the trial balance. The last ledger account to consider is our expense, our rates account. It has a balance brought down of £340, and that will be on the debit side of the trial balance. If we have completed the double entry throughout this presentation correctly, we should now end up with a trial balance which agrees. Our debits and our credits should now balance. And they do. And that provides confidence that the double entry we've completed throughout this activity is correct. And that concludes our PowerPoint on trial balance and double entry transactions. I hope you found it to be of interest.